and I feel terrible about going behind her back, but I need my working relationships to be predicated on trust and that basis. I think we're doing understandable.
So good evening, ladies and gentlemen.
Good evening, Mwalimu.
Well, that confirms that
Good
I'm
evening.
audible.
Good evening, Mwalimu.
Thank you. That confirms I'm audible enough. Sorry.
Good evening.
Thank you. So we were able to get a donation. And when I say a donation, you know what I mean. But at least we were able to get an extra class that will give us at least time to cover a few concepts here and there. And to just pick from where we left last time, this was what we were doing, the cash flow statement using the indirect approach, having looked at a question using the direct approach that we were working on. Then we went to the indirect approach. However, we left it at somewhere where I was looking at a question came and I said, I'll use that to cover these concepts of non-current assets, where we have a company that maintains non-current assets at cost, and another one that maintains it at carrying amount. So when you use cost, you use cost and accumulated depreciation to find missing figures probably. But then we were able to see another account where you are not given cost and accumulated depreciation, you are only given carrying amounts or net book values. And this was where we actually stopped it in our last class. So before I go to any other concept, I want to ask if there was any question from these concepts of the non-current asset accounts before we go any further. So I say that whenever we are looking at those non-current asset accounts, they help us find the following figures. Whenever you are dealing with non-current assets, then in the statement of cash flow using the indirect method, then there are several figures probably you are going to calculate. All those figures that are dealing with non-current assets. You have what we call the depreciation expense. If not given, then probably is one of the missing figures that should be found from those. Loss on disposal, profit on disposal will also, involve non-current assets, and probably you will get it together with those other figures. Then when you come to cash received from sale of non-current assets or cash paid to purchase non-current assets. So all non-current assets figures, you usually get them, either from some are given directly in the question, some of those you may actually need to calculate them from the information given. So that is what I had actually intended with that non-current asset accounts. So, but to continue with the question, whatever we were doing in this question, we were calculating actually so that you don't lose track. Remember, it's the question we were actually still going on with is that we were doing a reconciliation of the profit for the year with the cash from operations using the indirect method. A reconciliation of profit for the year with cash from operations. And when you check that under the indirect method, this is actually where you take a reconciliation of profit after tax for the year with the cash from operations, this one, which is actually the cash from operations is the one that is given here under the direct method. Already we have got it as 2980. So what we were doing, we were trying to reconcile the profit after tax of 852, so that we use the indirect method to see whether we can arrive at the cash from operations of 2980. By so doing, then we'll be able to actually demonstrate that whatever is in the statement of profit or loss is actually what we have recorded here in our financial statement. Now, when you look at that, so we had started from their profit after tax for the year, add back tax expense, which we did here, profit before tax, which is this, and then we were able to get add back depreciation, which was this, add back depreciation, add back loss, less profit. So add back loss on disposal, we did not have a loss, but less profit on disposal for 470, which in the question was actually found by looking at the assets which had been sold. So I hope that, we are picking up. Now, the problem of leaving a question midway sometimes, hope, I'm trying to give this, hope people can remember where we actually were in our last class with that question, is that we looked at that concept where we said this asset disposal, a building having a value of 5,000, cost and having accumulated depreciation of 3,000, then we realize was disposed cash from sale of building 970. So 5,000 minus disposal, 4,500. So 5,000 minus 4,500, we got a remaining value of 500. Then we sold it at 970, which did give us that profit of 470 that we were dealing with there. So that is where we stopped. So in short, we were still following this format here. So once you have got add back loss on disposal, less profit on disposal, then you are to adjust for all this, inventory, receivables, payables, accruals, prepayments, and add back any interest expense. Now, when you have gotten here, these figures from here all the way to here, I say these ones, you just compare current year figures with previous year figures. And if you are given financial statements, of course, you can compare. If not, try to check any other information you have been given. So let's start with the change in inventory. We want to check if the change in inventory, if inventory increased from the last period to our current period, we are going to less it. If inventory reduced, we are going to add it. So let's try to check in the question. And in the question, these were actually in additional information here, where we were told, for example here, stocks were 1.5 on January 2021 and 1.7 at 31st December 2021. So my question to you is this. Did stock in the period increase or reduce, and by how much? Any volunteer? Yes, Jacob.
Stocks increased
By how much?
by 200,000.
So stocks increased by 200,000. So when there is an increase, remember stock is inventory. So when there is an increase in stock or inventory, what do? We add or we less? Add or less increase in inventory. So they increased. So what are we going to do? Less 200,000. So we come here and say less increase in inventory. $200,000 is 200 because figures are raised in the financial statements there, or figures were raised. If you remember, you are working with raised figures. Any question there? Next is receivables and then payables. So change in receivables and change in payables. We also come to the question and we check. Remember, debtors is what we call receivables and creditors is what we call payables. So on 1st January 2021, debtors were 300,000, 31st December 2021, 450,000. So tell me the change and what we are going to do with them. Trade debtors. Any volunteer? Yes,
This is
Majid.
Yeah, Mwalimu, it has increased by 150,000. We therefore less it by the same amount.
So receivables. And by the way, what is the logic behind this? I remember last time explaining. What is the logic behind this? You know, when you are debtors are people who owe you cash, correct?
Yes.
So if people who owe you cash have increased, you know, the amount of cash owed, you know, last year a friend owed you 300,000. This year the friend owes you for 50,000 in quotes. What does that mean? It is that you have again given them an extra debt of how much?
150,000.
Was it money coming in or going out?
It was supposed to be money coming in, but it went out because you gave it as a debt.
So it increased. So you actually increase the money going out. So you actually gave out your money, and that's where we are lessing it because it's a cash outflow. It indicates a cash outflow indirectly. Same with inventory. You know, inventory means if we have acquired more inventory, we have used money to get that inventory. So also less increase in receivables. Less 150. And then we have payables. Let's check payables, the change in payables. Trade creditors last year were 500, this year 475.
Decreased by 25,000.
It indicates there is Mawira.
Decrease, madam.
A decrease.
Yes.
So if payables have decreased, last year you owed, okay, suppliers 500. This year you owe them 475. What does that mean?
Means you paid them 25K.
So you've paid them 25K. So again, we are going, it's an outflow. So we are gain less. So that's where we less decrease in payables or trade creditors. And that was how much? 25?
Yes, 25,000.
So the same concept applies to accruals and prepayments. So you check whether you are given accruals or prepayments in the question. So good. So I have accruals and then I have prepayments on. Point number 3 tells me, other expenses include insurance, which is paid a year in advance on 30th June. In the year 2020, insurance of shillings 300,000 was paid. The amount paid in the year 2021, which is paid in 20, was 400,000. Good. So we have paid insurance in advance as at 2020. Starting, we had prepayments of 300. Closing, we have prepayments of 400. So prepayments are like receivables because they are current assets. So there is a change of 100,000. What are we going to do with that 100,000 in our cash flow?
It's money flowing out, so we'll subtract.
Money flowing out, so we subtract.
100,000.
100,000. Good. What about accruals so that we deal with it? Accrued wages were 75,000 on 1st January 2021 and 95,000 at 31st December 2021.
There is an increase, so we add because it's money retained in the office.
Come up again.
There's an increase, so we add it because we are retaining that money. It's accruing back. We have not yet paid the wages.
Good. So it means, yeah, in layman, it means it's as if you have actually taken more credit. You have taken more loans because a current liability, 25. So
20.
that is 20 and 100. Okay. So less increase in repayments, add an increase in accruals. That way? So you see, those are sometimes when you get the statement of cash flow, I usually say this is one of the easiest section because it does not involve a lot of calculation. These 4 figures, 1, 2, 3, 4, 5, almost 5 figures. For them, in most cases, you'll only be comparing from one period to another and finding the change. So in most cases, you don't actually struggle much to find those figures. Then you are told to add back interest expense. This is given as interest expense or sometimes not there. And when it's not there, you can get it from this interrelationship. If you have interest paid, you have interest liability from last year, then the interest expense in the P&L is the missing figure, then you less interest liability in the current year. And, in the next question, probably we'll be able to see some of the illustrations here using this. And the same happens for even tax paid if it's not given directly. Now, what was the interest expense in this question, if any? Add back interest. Remember, interest expense may not always be the same as interest paid. Why? Who can tell me why? Yes, Nicholas. Sorry, your hand is up.
Yes, Molly, mine is a question.
Yes.
How do you treat provision for bad debts and bad debts written off in the cash flow?
Now, we don't actually treat them because we assume now that has already been accounted. That is not a cash outflow or any cash because you're not going to get it. So what it does, it is actually accounted for within the income statement without affecting the statement of cash flow because cash will never move by that item sometimes. Okay, because we adjust it in the provision. Remember the receivables figure, the way we write it off. Now, because those figures have been written off from the receivables figure, so by the time we are netting, we are now comparing the receivables figure this year and the previous year, then they have actually been accounted there. If we try to account for them again, it will be double because they have already been deducted from the receivables figure. If they hadn't been deducted, correct, the profit will have been different, okay?
Yeah.
And the change in receivables will have been different by the same amount.
Okay.
You get that?
Yeah. I think I was a bit mixed up because of the adding back we are doing for depreciation.
Oh,
and
okay.
that perhaps the treatment should be similar.
Yeah, and in fact, if we were not adjusting for receivables, okay, then that could have been done. But now, because we are going to adjust for receivables by comparing the opening and closing, and these figures that we have taken to the P&L that have affected the P&L, then they have reduced the difference between the receivables at the start and the receivables at the end by the exact amount.
Okay.
So because of that, it balances itself out. Good. Now, I was in the interest expense and I asked a question. Why is it possible that our interest expense in the P&L is not the same as the interest paid? Why are we adding, the same way we added tax expense, then later we'll now deduct the tax paid? Why are we adding back interest expense and then later now deduct the real interest paid? Why will the two figures be different? Yes, Nicholas Mwangia.
The other one has been settled.
Yes?
Can you hear me?
Yes, Nicholas.
I'm saying, could it be that one of them is an accrual while the other has been already settled in terms of an expense?
Okay, yes. So what we are trying to bring is, whatever we recognize in the P&L, Daniel, maybe you can add something before I
was trying to say that whatever is in the P&L doesn't mean we have paid it already. So the interest can also accrue in the long end year. So that's why I was thinking that it can end up being an accrual. Hence, we have to interest for the last year, then we add what we have, then we subtract for the current year that we have to see what will be left is what we had paid, because we can have an expense in the profit and loss, but it doesn't mean we have paid it. It can end up being an accrual.
Good, yes, and that is now in Tamaria to the two concepts that you've said and what Mwangia said. We are going back to the concept of accrual concept, where we say, remember in the accruals concept, the transactions we recognize in the P&L do not necessarily mean that we have paid them. So that is why whatever is recognized in the P&L is not on a cash basis. It is on an accrual basis. It could be that you have actually recognized the interest and you have not paid it at all. So that's where you add it back. Then check if there is any interest paid. And if there is no interest paid, then you don't account for it or you don't add it back. So essentially, that is the reason why. It's because of that accrual concept. So in this question, we had, let's check, we had interest, add back any interest expense in the P&L. So the interest expense in the P&L, if there is any, is, let's check, interest expense in the P&L. There is, you are told, all the 700,000 paid on the finance lease in the year represented capital. This was the first year of the lease and interest was not paid. There was no interest paid until the second year. However, interest as at Kenya shillings 43 was included in the year 2021 financial statement. So it means there was interest expense included in the financial statements, which is the P&L of 403,000. So you add interest expense of 43. So that is now what we needed to have there for us to reconcile all the way back to cash from operations. Cash from operations. So let's check, does it rearrange to cash from operations? So a reconciliation statement that was actually up to that moment. So probably the examiner asked this because he knew that is what he had given in the statements. The other maybe things downwards using the indirect method were not easier to calculate because, as I said, this is where it differs. We will assume all the other, now here, we'll assume that all the other concepts from here, interest paid, taxation paid, will actually be the same now downwards for the indirect approach, because majorly you realize the indirect and the direct approach usually differ on the first section only. And once we show it, then you can see that the two figures will actually realign 2980, and here cash from operations should also come back to 2980. So once they have agreed, from there now going downwards, they should have the same figures. Any question up to there? So this was a reconciliation.
Mwalimu, why don't you subtract actual interest paid since we've added back the accrued interest? But what about the actual interest paid in that year?
Yes, now when you check in this method, that is where it comes. You see, immediately after cash from operations, we get less interest paid.
Okay.
Yes, so if we continue, but again in this question, there was no interest paid. That's what I'm saying. You see the same now from here. You see, when we use the direct approach, we said now interest paid, tax paid. So everything now will again be the same. If I was to do this, I'll say if I was preparing this using the indirect approach, I will still have actually this and continue it down now this way from here. That way. Probably saying that still that could have been still the direct method approach, correct? Sorry, the indirect, that all the way down. By the time you get here, now you have actually come back where the two methods now meet each other. From there, they continue exactly the same way. So even if we were to continue, we expect that we are going to arrive, or we'll have the same things that are here, even in the indirect approach. Okay, that is where the examiner knew and said, you prepare the statement of cash flow first using the direct approach. Then now show a reconciliation between the profit after tax and cash from operations to show that now the two methods, whether you are going to use the indirect or the direct, you should actually arrive at the same figure for cash from operations, 2980 and 2980. So usually the direct approach is very easy, and that's why I told you the only problem is, realistically in accounting, it does not help us link to the other financial statements. So in the indirect approach is the one that in most books, when you look at books of accounts, the indirect approach is the one that is actually advocated for, especially in the private sector. Good. So unless there is a question, maybe we can look at another question where again we look at, symbol figures that we have to try and see how, when given again another full question, probably, I'm using the examples to show you, what you could do in detail when confronted with a scenario. Okay, so let me bring the other question. Give me a minute, I copy it. Plus F. Okay. So XYZ Limited closes its books every 31st December. Given below are the comparative statement of financial position of XYZ Limited for the year ended 31st March 2017 and 2018. Can you see my screen?
Yes, we can.
So this is our current year. So the first thing you need to identify again. So this is our current year. And the other one is our previous year. So you have non-current assets. Now check here. You are given land and building, motor vehicles, furniture and fixtures. So the way you are given these figures in the financial statements, before we even go into additional information, here in the financial statements, the non-current assets, are they shown at the cost or are they shown at net book value? They are shown at what value? Yes, Nicholas, and then I have, okay. Mulidwa Jacob.
They are shown at cost.
They are shown at cost.
Yeah.
So if they are shown at cost, usually at the reporting date, how do we show the okay, when we have been preparing our financial statements, whenever we prepare on current assets, I usually have three figures. One.
The cost.
Then
we have depreciation.
Which depreciation? In the statement of financial
Accumulated
position.
depreciation.
Accumulated depreciation.
Then finally the net book value.
Then net book value.
Then net book value. So whatever we take, so net book value is a difference between the cost and the accumulated depreciation. So if you are only given one figure, what will that figure be?
Net book value.
Probably the net book value, because in the statement of financial position, using the historical cost method, concept usually say transaction will be shown or accounts will be shown at the historical cost, but at each reporting period. And you see one thing you need to maybe, Jacob, if you say they are shown at their cost, so why do they have a different cost in 2017 and a different cost in 2018? Okay.
I understand.
Probably you could say they have purchased more, which also would make sense.
Yeah.
You get that? But, and that is why we look at more. So whenever you are given one figure like that one, then we look at that these are actually the net book values or the carrying amounts. That at this date, land and building is reported at 95. Last year it was 55. So already you start getting an idea. Either there was a revaluation during the year, or we purchased the assets, correct? Already that gives us an indicator. Same for motor vehicle. We had 35, now we have 46. So either also there is a revaluation or purchase. For furniture and fixtures, we had 28 last year, we have 25 now. You know, that can only mean either we have a disposal of assets or only depreciation. You know, it has gone down. Good. Stock. Stock last year was 20, this year 28. There is a change of how much?
8,000.
8,000 increment.
So there's an increment of 8,000, which we are going to know what to do with an increment for stock. Debtors,
A decrease of 2,000.
so we have a decrease of 2,000. And the prepayments,
A decrease of 2,000.
also a decrease of 2,000. So the change is that. So bank balance and cash in hand. Last year, we had a balance of how much?
3,000.
3,000. So this 3,000, this year we don't have. So this was a positive. This year it means we don't have. Either we zero or we'll check whether it has gone to a negative in the overdraft. We close there. Ordinary share capital. Last year we had an ordinary share capital of 50. This year we have ordinary share capital of how much? 80.
80,000.
That will indicate many things. We have given new share,
Mhm.
new shares, correct?
Or appreciation also, right?
Or
Or appreciation in shares.
appreciation in shares. Now, what you realize that even if shares appreciate in the market,
They don't
we
affect.
don't account for them in the books of accounts. Shares, the way they are traded in the market, do not update their nominal value or par value remains, because ordinary share capital usually records the par value, correct?
Mhm.
So the par value cannot be updated
Change.
with any change in market value of shares.
Okay, that's noted.
Yeah. So share premium could also, it has also changed. For share premium, it will change actually because of reserves, will change of giving new shares and all that. Or it could be that we have actually reduced it, but it shows that it's an increase, so we are going to check. Revaluation reserve was 25 million, now it is 15. This is funny, so we'll want to check why in the additional notes probably. Retained profits, last year we had 15, this year we have 18. So already there is a movement in profits, but we'll also want to check how. Non-current liabilities, we have two non-current liabilities. 10% debentures. Last year were 20, this year 30. It means there is an increase of how much in long-term loans?
10,000.
So probably we receive long-term loans, but until you'll check in the additional information to see if there is anything on that. But for the bank loan, last year you had 10 million. This year you have 6 million. What does that indicate?
We paid off.
You paid off around 4 million. But we are going to check any. Now, trade creditors, last year we had 15. This year we have 23. What does that indicate?
An increase of 7 million.
An increase of 7 or
No,
8?
sorry, 8.
8. Interest payable now, this is what we were talking about in that formula when I was saying the interest the previous year, interest payable in the current year, then you are going to look at the interest expense to know what was paid. You are going to see now where that formula. For tax again, I'm also going to show you where this is going to assist us. Proposed dividends and bank overdraft. So you can see now at the start, we had a loan, we had a bank balance of 3 million. But by the time we are closing, we have a bank balance, which is a negative bank overdraft, 4 million. So we started with 3 million. Now we have a negative of 4 million. During the period, cash has changed by how much?
Negative 7 million.
Negative 7,000. So negative 7,000. So we expect, so that is what we are going to reconcile. That cash, opening cash was 3, now we have gone to negative 4. So you are going to realize you are going to have a decrease. During the period, we had a decrease in cash and cash equivalents of 7 million. So our statement of cash flow is supposed to show us how we were able to move from a positive of 3 million all the way to a negative of 4 million. Good. The following additional information is provided for the year 31st March 2018. Land and buildings were revalued upwards by 10 million during the year. In addition, an acquisition of land and building of 40 million was made. Okay. Depreciation on motor vehicles amounting to 40 million was provided in the profit and loss account for the year. Motor vehicles having a net book value of 8 million was sold at a profit of 3 million during the year. Bonus share of 20 millions were issued at par during the year by utilizing the revaluation reserve. XYZ shares have a par value of 20. Now, what does this mean? First, a bonus share, I know you've done, whenever I ask this, I say, in accounting, for me, I did what we call company law. That is what I can only relate to law. Of course, we had some few issues there of law of contract, law of torts, but what we do in detail as accountants is company accounting and, company law. And when you're looking at company law, I know you usually do those small aspects. Now, assuming that we do it in company law, so I know lawyers could be doing it somewhere in detail, issues to deal with company accounting, but from the perspective of law. So you know the difference between bonus shares and rights issue of shares?
Mm-hmm.
Yes, what is the difference?
Rights issue, Mwalimu, is like an IPO to raise capital. Whereas
so you
bonus,
receive cash.
Yes, you receive money.
Okay.
Whereas bonus is eating up into your reserve or into your cash because you're giving out additional shares. So you're literally giving out equity, so to speak.
Good. You see, the reason I say that, so that you can come here and correlate. You see, I want you to correlate how these figures are moving now. So we have been told, the only thing we have been told about revaluation here is we valued land upwards by 10 million during the year, correct? So we started with a revaluation of, you started with a revaluation of 25 million. Oh, sorry, I'm actually on a different worksheet. Okay. So, so you started with, let me close this way. I copy the question from, has been, sometimes I am there and, sorry. Yeah. So, here, for example, let me check here. So we started with share premium of 15 million, correct?
Mm-hmm.
So we have been told land was revalued upwards by how much?
10 million.
10 million. So assuming that was because we don't have any other revaluation. So we expect the revaluation account to have how much?
25 million.
Sorry, we started with 25. Sorry, not 15. This was our previous year. You see, now those are the things we should always remember. I'd already taken this as my previous year. Sorry for that. So my previous year was 25. I had 10. That should give me how much?
35 million.
35. Then we are told we issued bonus share of 20 million from utilizing the revaluation reserve. So we again transferred 20 million from the revaluation reserve to the share
capital. Yeah.
So we remain with how much here?
15.
15.
million.
Is that what we have remained with?
Yes.
You see already that reconciles. You see, it even shows how your movement on revaluation reserve went around. Okay. Now, with that, having known that we gave a bonus issue and we have accounted for it,
Excuse me,
already
Mwalimu.
that, yes?
I've not understood. Why have we said the revaluation reserve was done for 10,000? And yet I can see from the question, the revaluation reserve was 25. It went down to 15. So I think that's a devalued revaluation.
Good. So we are saying this. So let's work together. So last year we had revaluation of how much?
25.
5 million.
So we had revaluation of 25. But you have been told during the year we did revaluation, what I was trying to account for. Land and building were revalued upwards by how much?
10
By
million.
10 million. Yeah.
So whenever we revalue an asset, we usually say you are going to increase the asset by debiting the asset, okay? And you're also going to credit revalue account. So it means this revaluation, if we started with it 25, during the year we are adding how much to that account?
10 million.
10 million. It should have given us how much? Should have given us 35, correct?
Yes, that's correct.
But again, we are told in the question, bonus due of 20 million. Are you saying that? A bonus issue of 20 million were issued at par during the year by utilizing the revaluation reserve. So it means we actually transferred 20 million from the revaluation reserve to where? To the ordinary share capital. So it means we reduced, after increasing the revaluation, we again reduced it by what amount?
By 20 million.
20 million. So what should you remain with at the end of the year? 15 million. Is that what you are remaining with? Here.
Oh, yeah. I
Yes,
can
it
also.
is.
So what I was trying to illustrate is already the revaluation reserve reconciles itself, which tells us other than revaluation of land, then it means there was no any other revaluation during the year. Okay? Are you together there?
Yes, you're together, Mwalimu.
Good. Now, you see, there are two approaches you can take in a question. So there are two approaches you can take in a question. I've dealt to take the approach of doing all the calculations first, then we go to the statement of cash flow. You can decide to just prepare your statement of cash flow, then just insert the easier figures. Are we together? Then you start looking for the other figures. Which approach works for you? Okay. That you can just start by adjusting the other figures, and then you look at which approach works for you. Or you can actually take all the calculations first. But most students get this approach working for them of taking the statement of cash flow, for example, the way we had here. Let me show you this. They decided this way. They decide to go with this approach. Just an example here. They say that for them, but you see now here, you must know the format. And probably this could also work. That there are figures they know they can get easily. If they know the format, they write it down. Then now they start working with figures they know. Okay, just clearing. So to them, they say, and what did you realize were the easiest figures to calculate if you have a blank workspace like that one? What were the easiest figures?
Then I'm
For me,
correct.
for me, I get the easiest figures to be these ones.
The current assets and the non-current liabilities.
Yes, this one and this one, this side and this side, where we are comparing cash flow from received from long-term loans or paid to long-term loans, these two. So can we start maybe just filling before we lose track? Because sometimes when I start with workings, people end up losing track. And that's why I said you can now use inventory, for example, in the period. Inventory, we said, increased by how much?
8 million.
8K.
8K. So we just say increase in inventory should be less, 8K. Receivables did what?
Decreased by 2,000.
They reduced by 2 million.
So we should do what? Add decrease in receivables. Receivables when it decreases from the original. So add decrease in receivables, 2 million. We can finish with prepayment before we go. So prepayment also did what?
They reduced by 2 million.
Also reduced. So what do? We add or less?
Add.
Add. Add decrease in prepayments. We go to payables or creditors. So payables or creditors. Trade creditors last year was how much? $15, this year 23. So it increased by 8. So when creditors increase, what do we do? What does that mean? You ask, have we brought in more money from creditors or we have paid?
Brought in more money.
So it's a cash inflow, correct?
Yes.
And increase in payables of 8,000. Anyone up to there, easier concept, anyone up to there in that concept of accruals and prepayments, because we don't have accruals for now. The reason we don't adjust for interest payable and tax payable because they have their own sections separately. Or dividends.
Mwalimu, a minor correction.
Yes.
On the worksheet, you add increase in payable. You have written less. Colleagues, some of my colleagues might not be present.
Yes,
so
yes.
Once you're sharing the worksheet, might become problematic.
Sure. Add increase in payables. Yeah, sure. Thank you. We said add increase in payables. Good. So being nothing on accruals is 0. So sometimes I say that if you know the format, sometimes you can never spell 0. What I always say in accounting. You come here, then we get cash received from long-term loans and any cash paid to long-term liabilities. there was long-term liabilities of debentures and bank loan. So what you only need to check if there is any other information about them here, in additional information. I don't see any information regarding them. So we go back and check them. So non-current liabilities, 10% debentures. Did they increase? Did they reduce? Especially those friends of ours who are very quiet. If you are following, at least you tell us what is going to happen here. And today, just for nothing, my sisters, where are you? It's as if the class is has gender discrimination.
We are
Today,
keenly listening, Mwalimu.
they are keenly listening today. You know, sometimes I also get concerned. Could I be leaving too many people behind? But if they are, well, we hope they are following. Because since they started, I've not had any of them come up. But well, let's continue. No, I assume. I don't know how part-time classes work. Sometimes when I teach other part-time, people will tell you, if you select someone to speak, they tell you, Mwalimu, I'm in a matatu heading home. Kindly allow me not to unmute. So we don't want to go that direction. So yeah, so whose hand was up? Was it Nicholas? Yes. Yes, Nicholas. So for 10% debentures.
The debentures have increased by 10 million, Mwalimu. So we add them because
so we say here,
it's a liability.
Good. So cash received from, you can specify 10% debentures. 10 million. But this approach could work, especially because really will things balance for you in the exam. So when you just want to put figures you are sure, then bank loan reduced. So we paid off, cash paid to long-term bank loans. And negative because we paid of 4 million. And we said, you see, I can put whichever figures I put there, but we said we even know what is going to be the cash movement. We can put it at the end, or we know what was our cash at the start of the year. Opening cash was how much? We are going to say our opening cash was opening cash balance in the period we said was how much? 3 million?
3 million.
And the closing?
Negative 4 million.
Negative 4 million. So you see that 3 million, closing should give us negative 4 million. So what was the net movement in cash and cash equivalents?
Minus 7 million.
Minus 7 million.
Negative 7 million.
So this approach sometimes works. Of course, me, when I'm working it, probably because I want to do the workings, but especially when you are not sure about the workings, you can start with the easier figures and, just put them, and you are good to go. Now, let me come here now. From here, I usually go to cash received from issue of shares. If there is usually nothing, this is how we do it. We have already seen that last year we had cash. If I want to calculate cash received from issue of shares. Issue of shares. So in the previous year, because when we get previous year, when we give out shares, we can issue shares at a nominal or at a premium. We usually take share capital and share premium together. So last year, we had share capital of 50,000 plus share premium of 15,000, which gives us a total of how much?
65.
65,000. This year, current year, we have share capital of 80,000 plus share premium of 20,000, which gives us a total of 100,000. So the change in the year is a total of how much? $100 minus 65, 55. So not 55, 35.
35.
Yes. So if the change in the year is 35, but we know of this 35, 20,000 of it came from where?
Bonus shares.
From bonus shares. Bonus issues. So it means a bonus issue, we never received any cash.
Mwalimu, just a clarification.
Yes.
Are these amounts in millions or thousands?
So you see, they are in millions because, okay, they are in thousands as per se, because here you see this is 20 million, correct? Like this one, bonus share of 20 million, okay?
Yes.
When we remove 3 zeros, we remain with
Thousands.
20,000.
Yes.
Because that was what was raised here in the question. It was raised to 1,000. So whatever figure I'm using here, of course, it's 20 million. So this was 35 million, this is 20 million, but now we are working in thousands, correct?
Okay, that's noted.
So it means the cash from issue of shares now was how much in the period? Because the increase, some of it we have seen is from bonus share. So what came from issue of cash now of shares? Cash from issue of maybe rights or new shares. You get 15 million?
Yes, 15 million.
Good. Cash from issue of shares, 15 million. So we come here, cash received from issue of shares. Here, cash received from issue of shares, 15 million. So any question there from cash in from issue of shares? And that is why probably I told you sometimes there are those questions that you can have, all those figures that you can have direct formulas. Others you have to check. Like now that one, if you have just checked here, ordinary share capital, there are most people who have taken 35. Then you later realize there is, that is where you first need to check the additional information if there is anything that relates to that figure. Okay. Good. Which other figure? You see, just look at the question. Which other figure? We have figure. Interest expense charged to the profit or loss account for the year was 800,000. Interest expense charged to the profit and loss account for the year amounted to 8. But later you realize, yes.
What about the position of XYZ ordinary shares have a par value of 10 shillings 20?
You see, that will only tell us the number of shares that were issued, bonus share that were issued. Because if we give bonus share of 20 million, 20 million divided by 20 gives you how many bonus shares were issued.
Around 1 million.
Around 1 million, which of course to us does not, we don't want the number of shares issued. Does not, us in accounting, we are dealing with monetary value,
Okay.
unless there is somewhere where those shares will assist you calculate something. But in the financial statements, we want the monetary value of those shares, not the shares only.
Okay, well, and also if in terms of what you stated earlier, if the company had allotted more shares, maybe for IPO, we would have added because that would mean they have received money from the sale of share, right?
Come up again.
So if the company had allotted more shares which were sold out, or maybe IPO as what was the first discussed, that means we would have added instead of subtracted.
You see now, that will also appear in the statement of cash flow. In fact, what we are trying to calculate is this. You see the 15 million we are trying to calculate. We are assuming during the year the company, the only way share capital can increase is when you give out new shares, correct?
Correct.
So if share capital has increased, and we have seen the increase is 35, but only 20,000 can be explained from bonus shares, then it automatically means the other 15 million must have been a rights issue or an IPO. But you don't use an IPO. When we use an IPO, we assume initial public offer, yes, of course, that the company is now going public, but we assume it's public by the time it's giving a rights issue. So we usually say rights issue in most cases. What you will see in accounting, in a statement of cash flow, in most cases, is the word rights issue. When you see rights issue, so that is when you give shares for cash. Okay?
Noted, Mwalimu. Thank you.
Yes. Now, the interest expense. Now, when you check interest expense charged the statement of profit or loss for the year amounted to 800,000. However, this figure is actually a figure that later we are going to see. For now, just use 800,000. Then I'll tell you why, when we were doing the question, you realize probably it could have been 8 million and not 800,000. Just by checking that probably there was a problem in that, but for now. So you see you have figures. Profit after tax for the year amounted to 8 million. So let's go and put it there. Profit for the year, profit after tax, 8 million. I'm just picking figures, 8 million. So you come here and say profit after tax was 8 million. See, before you calculate any other figure. So we have said interest expense charged to the statement of profit or loss account for the year amounted to 800,000. I'm saying for now we are using 800, but later we'll let's continue with it, but you'll see why probably after we have finished the question, you realize probably that is what was bringing all these errors we will have of like negative tax paid. So you have tax expense of, let's say, add interest expense in the P&L, 800. Those are figures I'm picking. Hope you are seeing where I'm picking from. Note 4 and note 7. During the year, tax amounting to 6 million was paid. So you go where tax paid is. Not tax expense, tax paid, 6 million. Taxation paid, 6 million. Good. So majorly, now the other figures we have remained with are now calculations that we must deal with them. And now, the first figures I want to start with are actually, you are told motor vehicle, or there is also motor vehicles having a net book value of 8 million was sold at a profit of 3 million during the year. Two figures we can get there. So we have profit on disposal from the motor vehicle of how much? 3 million. So you go to where we have profit on disposal of non-current assets. Profit on disposal of non-current assets. Here. Let me remove the bold in them. I was wondering. Profit on disposal less 3 million. So if we disposed the asset and made a profit of 3 million, by the time we were disposing it, it had a net book value of 8 million. What does that indicate?
We disposed it at 11 million.
We disposed it at 11 million. So that means cash received from sale of motor vehicle. Here, cash received from sale of building or sale of motor vehicle. So we check land and building were valued. In addition, an acquisition of land and building was made of 40 million. So we only have there, but we can actually say if there's anything, we are going to come and add it there. Cash from sale of motor vehicle, 11 million. And we have all seen how that comes about, that you have an asset valued at 8 million. You dispose it and make a profit of 3 million. Then you are selling it at higher value of 11 million. So that 11 minus 8 to have given you the profit of 3. You see, this approach works if you know the format. You can, fix figures before you even go to complex issues. Good. Now, I want to go to, there are figures here, if you remember, that are given formulas. I usually calculate non-current assets the last because here, I want to bring this here. You see what I meant. There are figures here given. Good. So, there are figures we want to calculate here. Tax expense given or use additional information given to compute. So we are not given the tax expense directly. Are we given the tax expense directly? We are only told tax paid of 6 million. Okay, so if there is none, then we come back here where we have tax paid. So if you have been given tax paid, probably tax expense is the missing figure. Check here. We have said tax paid here. You take the tax paid equals to the tax liability from previous year plus tax expense in the P&L minus tax liability in the current year. This formula, you are seeing it. That for us to get tax paid, we are taking that 6,000, usually the tax paid, now not the negative, but the tax paid as a figure, 6,000, should have been equal to tax liability from the previous year. We go to current liabilities and get tax liability, tax payable from the previous year was how much? 5,000, correct?
Yes.
Then in the current year is 6.
Mm-hmm.
So should have been 5,000 plus the tax expense, which we don't know K, then minus 6,000. Should have given us again 6,000. So what was K? Which is the tax expense? See, that is what we are given there. What is going to be the K?
Minus 5.
100,000.
11.
Really?
11,000.
Apana. K. Okay, let's do this.
12,000 minus
6,000
7,000
plus 6,000 minus 5,000 equals to K.
7,000.
Yes.
So K equals to
7,000.
7,000. So that means the tax expense was 7,000. Using this, I've used this formula. Hope you can see this formula. I'm talking about this formula for those ones. Talking about this formula.
Mm-hmm.
Okay. Tax liability from last year plus tax expense in P&L minus. So this minus tax liability of current year. So that means the tax expense. You see, when you are given one, the other is missing, correct?
Mm.
So add back tax expense of 7,000. So profit before tax was probably how much?
15,000.
15,000.
Mm.
Are we together then?
Mm-hmm.
Okay. So today we are only doing methodologically statement of cash flow until we get it right. And and you see, by this approach, I'm showing that you can actually, but by the time you are filling all these figures, even if you were to stop there and then, probably you could have gotten, even if it's 6, 7 marks actually, because as I said, there could be more marks in a question than even that allocated. It's over 10-mark question. Now, we go to the other one I wanted is the same. The same concept applies for interest paid. Interest paid we also take interest liability from last year plus interest expense in the P&L minus interest liability of current year to give us the interest paid. So interest paid, we don't have it, is what we are looking for, K. What I'm missing, X, should be equal to interest liability from previous year was how much? Let's check down here. Interest payable from last year was how much? 6 million?
6,000.
So that's 6,000. Then in the current year is 9,000. So 6 and 9. So 6 should be equal to 6 plus interest expense in the P&L. How much? 800. Then minus 9,000. What do you get?
Negative 2,200.
Negative 2,200. And that is why I said, I suspected, when you look the question, you realize probably this figure of interest expense should have not been, because you cannot get tax interest paid a negative. Okay? This should have been 8 million. And I said that is why I suspected this interest expense in the P&L could have been 8 million, not 800,000. Okay? However, in the exam, when you get such, you can just deal with it the way it is. Because now, you see, I told you practically, before marking starts, so never, be worried. When a question has an error, it is taken care of during marking, because if students have used, all students, and when you correct, you can actually correct and say, I took 8 million, and it will be, because the examiners will try to redo the question. And once they run into a problem, then they realize there was a problem. So it should never worry you too much. No students will say, what, because that was the next question I was asking. What happens? I was expecting, sorry. What happens in the exam? Okay. So, and that is where probably, you'll deal with it the way it is. So for now, I just deal with it the way it is, and there's nothing we can do. So interest paid so will be how much? 2,000 negative? You have got how much?
2,200. 2,200.
So plus 800 minus 9,000. So interest paid negative. So because it's a negative, minus will actually end up giving you a positive because it should be paid. So meaning interest paid, we paid a negative. So which should give us more of a positive of 2,200. Reason why it's becoming a positive? You see, tax paid should be a negative. Are you understanding?
It implies we received this money back.
Yes, it means you see negative. It means it's as if you actually receive the money back instead of paying. So it ends up becoming more of a positive now rather than a negative. It's a negative interest paid. So in the statement of cash flow, now it is not paid. It is actually more of received. So, but as I say, don't worry with those. Those are non-issues. You will encounter. You see now that and that will then end up balancing probably themselves again somewhere. Because now interest expense, if it was 800 here, then this becomes an interest expense. This should have been deducted, but again becomes a positive. But had we taken it as 8,000, probably things could have gone different. But anyway, so those are some of the issues probably you deal with. Then,
just a question.
yes.
On the same, if we took that 8 as 8 million instead of 800,000,
would
we still would we still take it as the positive 22,000 or 2.2 million?
No.
If this 800 was 8,000, 8 million.
So if it was 8 million, here we could have written 8 million, correct? Interest expense should have been then 8 million. Then here we could have said plus 8,000 minus 9,000. It should have given you how much? So let's assume we use the 8,000. So what do we get?
5,000.
You get 5,000. So the 5,000 is what was paid as interest, correct? Then you come here and say negative 5,000. Okay?
So it becomes a negative when it's a positive. Okay, so I've seen it.
Yes, you see, the figure is a positive. We are only showing it as a negative in there because it's a cash flow, but the interest itself balanced, the figure itself is going to be interest paid off 5,000. Then because it was paid.
Money. Okay.
So we cannot say we have negative 2,000. So when it is negative 2,200 paid, you see now you say negative, then it ends up becoming a positive. That's why the other one was coming as a positive. Okay?
Yes, okay.
In fact, we can work with that and assume that this was 8,000 for now, then we'll see. So assume this was 8,000 and there was a 0 there. Now, good. Now, from there, you realize figures that have remained now are majorly depreciation, any loss on disposal, which I don't think we had here, but depreciation, you just must check all the assets to check which depreciation they had. And then we have cash paid to acquire non-current assets, cash from income, income investments, cash from investments income, if any, if not told 0. So we need to get that depreciation and maybe get dividends paid. Then we can check how our figures realign. Now, for non-current assets, this is what I will appreciate you do for each non-current asset. Land and building, draw the carrying amount. So for example, land and building. Because they were given a carrying amount, So land and building carrying amount, then we have motor vehicle. Carrying amount. And this the reason why I should do them the last, because now they involve more computations. And then we have what? Furniture and fixtures. So carrying amount or net book value? No, carrying amount. Carrying amount. So the account here is at carrying amount. So you start with balance brought down or opening balance from previous year. Add any revaluations. Add any purchase of assets in there. Then on this side, now we have net book value of disposed asset. Then depreciation expense for the year. Then balance carried down or balance in the previous year, in the current year, not previous, in the current year. And so this should now balance. So we'll have that for each of them. So we start with land and building. So land and building, we try to check and then check what is the missing figure. Land and building, in the previous year, land and building was 55. In the current year, it's 95. So 55. Then 95. What other information do we have about land and building? Note number?
1, we have reevaluation.
There was revaluation.
So we have revaluation of 10 million.
And purchase. And purchase.
And purchase of 40 million.
40 million.
Are we told that land was sold in the period? Or any building? 0. So it means now we need to balance these accounts to check what was the depreciation in then, because now it's not balancing. Then it means the remaining figure is the one for depreciation. So their value is this one.
105.
105.
So that's 10.
So there was again depreciation of 10 million to balance that account, correct?
Correct.
So you see, in that question, you are either given some figures, others are missing. Let's go to motor vehicle. Any question there? Probably if I went fast.
Mwalimu, just to put it across.
Yes.
There is usually no devaluation of land. What happens is depreciation.
If there is?
You have said revaluation. So revaluation basically means we revalue the land and the building and they appreciated in value.
Yes.
So the land can never be devalued. It can never reduce in terms of it that is catered for under depreciation, right?
Yes. So meaning, in fact, what is probably depreciating is the building. You see, like a building where land sits. You see,
Yes,
it's known as land and building. So there is usually, if for example, the premises at KSL, all of them are valued at 1 billion. we assume the buildings and the land, but the component of land must be depreciated, correct?
Yes, Mwalimu.
So some of this depreciation is coming from the component of building, not land. Land can either be revalued or done what we call a revaluation loss, devalued. You know, revaluation stands for both revaluation upwards or downwards. If it's downwards, then it will be on the opposite side or a negative, more of revaluation, which is a negative.
Okay. And just to run forward, and I will say, because I don't want to open these T accounts in the exam, maybe I could just create a formula and say, for me to get the depreciation expense, I have to take open balance from the previous year. I add any revaluation that was done. I add any purchases for that year. Then I less the current price for this year. And I get my depreciation expense for the year. Will
That
be
is
in order?
perfectly fine. That is perfectly fine. In fact, these formulas I've summarized here, most of them. Interest paid. These are actually T accounts that have given us formulas. So if you do that still in non-current assets, you are perfectly okay. It's only because here you get figures are many, I decide to maybe draw the accounts. But that is still perfectly fine.
Thank you, Mwalimu. We can proceed.
Thank you.
Mwalimu,
So-
what about the disposed part, the disposed asset part? Because he has said he'd have the opening balance for the same year, revaluations for the same year, purchases for the same year, minus last year to get the depreciation. What if you had a balance or figure on the deposited assets?
Yeah, and that is why I've said now if it's to create a formula, you have to cater for everything. I assume that you know that he catered for everything. But if that, and that is why for land and building, I omitted giving the formulas because they could be a huge one which could confuse you. So I decide to draw the accounts, and here you just get the format. Anything that is reducing the asset is on the credit and the current balance carried down. Anything that is increasing them goes to the debit.
Okay.
Yeah. So motor vehicle opening balance. So let me finish this and then we can, after we finish the accounts, motor vehicles 35 and 46. So this was 35. This was 46. Then you check now any additional information for it. We were not told any revaluation of motor vehicle, and we saw all revaluation surplus was able to balance itself in the year, meaning there was no any other revaluation. But you are told in note 2, depreciation on motor vehicle amounted to 40 million was provided for in the statement of profit or loss. So in the year, motor vehicles were depreciated with a balance of how much? With a depreciation of how much? 40 million? Yeah, so 35, 46. So we had 40 million. There, 40 million was provided for. Motor vehicles having a net book value of 8 million was sold. So what was the carrying amount or net book value of disposed motor vehicle?
8 million.
8 million. What do you think was the missing figure in this account?
Revaluation.
Revaluation, we've said 0 because, again, the revaluation account surplus, we were able to account for it. You remember everything balanced. So it means there was nothing again revalued. And in most cases, probably you are told.
And the purchase.
Purchase in the year. So it means there was purchase of assets in the year. And that is why these figures sometimes I say that calculate them the last if you are not sure, because as starting formulas, they may confuse you. So purchase in the year was this minus this. 59. Let's go to furniture and fixtures. Balance from the previous year. $28, and then now we have 25. Then we have 25. We are not told of any revaluations in the year. We are not told, for you not to be told an asset was disposed because of the issues of loss or disposal, probably you may have been told the asset was disposed with a profit or a loss. Because of that, yeah, it's zero. And so we remain with two things that we don't have, purchase and depreciation. But if there was any purchase, then this we could have seen the balance carried down increasing. But the balance carried down is doing what?
Going down.
So probably what was there in the year?
Zero purchase.
Zero purchase. And then now what will balance the account?
The depreciation.
Depreciation of 3 million.
Sorry, Mwalimu, that's 28 million.
28. So this is?
Depreciation is 3.
3 million.
3.
Yes.
Yeah, the figure below there is 28, not 25. 3 plus 25.
Oh, 28, yes. The higher figure. So this is 3 million. So now let's go. You see from here now, sorry, you can say your total depreciations in the year were how much? 3 plus 40.
3 plus 10, 53.
Plus 10. How much?
53.
53. So depreciations in the year was 53.
Wow.
So are you seeing that that figure could take you ages to calculate, and probably there were easier figures you could fit in fast? Cash paid to acquire non-current assets. As this was add back, okay, positive. Then here should be a negative now. Cash paid was 40 and 59.
99.
99. We are not told about any other cash from investment income, not anywhere in the financial statements, not anywhere in the additional information. So we assume it's going to be 0. Okay, so not there, but here. Now, there is one figure that we are missing, dividends paid. Only then we can finalize this question, dividends paid. Now, in the last period, in the last class, I showed you first the concept between profit after tax, retained earnings for the current year, and retained earnings for the previous year. Let's come here. So, give me a minute. Sorry. So when you check these proposed dividends, then we have proposed dividends here, but then we have retained earnings. Retained earnings from last year were 15. These were 15 million. Then profit after tax for the year was 8 million. So if you had profits, retained profit from last year of 15, then during the year you add profits of 8 million. How many profits are you supposed to close with?
23.
23.
But we closed at 18.
But we closed at 18. What does that mean?
We paid the difference as dividends.
So minus 18, you get that what was given as dividend from the retained profit was how much?
5 million.
5. But remember, yes, dividends are paid from profits, but then you have an account for proposed dividends. Are you saying that? Last year 3, this year how much?
Last year
4.
4, this year 3. The
And
other way
that
around,
is
man.
where you see these 5. I want to show you where this 5 was also mentioned. So you have seen the dividend from the retained earning was 5.
Mhm.
It is the one that is actually now here. The total dividend for the year, both interim and proposed, amounted to how much?
2.5.
See, the sweetness of accounting, when everything is set clearly, you know, when the question is set, all the figures, you can actually link them to their respective places. But now it shows this way. This is how what happens. And when you go to the notes, probably you will see I'd given something down there and I said this. If you go to, I want you to check. Yeah, there's that. I'd given that formula in the notes. I'd given statement of cash flow. The ones I'd given at the bottom of the indirect method here. And I'd said this. That is where I've given additional notes. If you remember, I'd said this. Additional notes for dividends above, when they are proposed dividends payable in current liabilities, the formula for dividend paid changes. You've seen that? So dividend paid should now be equal to dividend paid. The dividend payable from previous year was how much? Proposed dividends payable from previous year was
4 million.
4 million.
Mm.
In the current year, we propose to pay again 5 million. So in total, we should have paid 5 million in the current year, correct? The liability we had from last year and what we were supposed to pay this year. But at the end of the year, we still have 3 million we have not paid. So how much did we pay in the year?
6.
We paid how much? 6 million. Okay. So that comes here, dividends paid 6 million. Net cash. Now we do net cash from financing activities. This. Cash from investing activities. And cash from operating activities. Okay, so these three figures, plus 66, 80. You see the three figures give you how much? Even if you were to do, let's see if the three can give us the change of 7,000, correct?
Yeah, minus 7,000 is correct.
Gives us exactly how much?
Minus
7,000.
7. Yeah.
You see already that shows me, you see the figure I had corrected here, I was very okay. See, that is why you can always know. So even the interest here paid, we actually did, it was supposed to be 8,000, correct?
Mm.
So
not 800.
Any question up to there?
I'm sorry, Mwalimu, to take you back. Kindly,
Yes.
will you elaborate further in terms of the dividend? Because I got lost from the retained profit and now the proposed dividend.
Yeah, exactly,
Why
Mwalimu.
Come up
why
again.
didn't you? I got lost in the retained profit and the proposed dividends. What happened to our retained profit? I got
So
lost
what we
there.
said, what I said is, and this is where I want you to check. I said when you check in the notes, I'd said for dividends above. Now this is what I've pulled from the notes I'd given. The formula for dividends, whenever we have retained earnings, you just say dividends paid. It's the relationship between retained earnings in the previous year, correct?
Correct,
Plus
Mwalimu.
profit in the current year, then minus retained earnings in the current year.
Yes.
However, I gave additional notes and said for dividends above, when there are proposed dividends payable in current liabilities, okay? Here, like now in this question, we have in current liabilities, proposed dividends payable, correct?
So Mwalimu, the language, these dividends payable, are they a provision or were they actually paid? That's what confused me also.
Now, when they are here when you are told proposed, correct? You see proposed, the total dividend for the year was supposed to be 5 million, but you have not been told whether it was paid, and that is where you need to know. So this is the concept. You are opening the current year, you owe shareholders a dividend of 3 million, okay? Yeah.
But Mwalimu, is written proposed, so that's what was confusing me. It doesn't say paid dividends, it says proposed, like as if it's a provision.
Yes, you
For
see now,
4,000.
if you say paid, then it's not a liability.
Ah, okay, so it's an accrual.
Actually, sometimes you get proposed dividend or dividends payable. Dividends, just like trade payables, okay? Interest payable, dividend payable, or current tax payable. Those liabilities we are supposed to be paying at the year end, we haven't paid. So from our profit for the year, we have 5 million, which we are supposed to be paying as dividends in the current year, correct? But again, from the previous year, we have a liability of how much? 4 million. So if you take the 5 million we are supposed to be paying in the current year, plus the 4 million we brought from last year as a liability. So in total, we owe how much we are supposed to pay? 5 plus 4. We are supposed to pay a total of how much?
9.
9. But by the end of the year, we now still owe 3. So it means out of the 9, we have paid 6 and we have remained with how much? 3 to pay.
Understood.
Okay. Good. Good.
So, Mwalimu, it means when we didn't have the issue of proposed dividend, we will go back to our previous formula for retained profit of the last year plus our profit, our part, the profit of our part, then add the current retained profit. But when they bring the issue of proposed, that's now things changes. Now we have what we are paying this year plus what we paid last year, and as what we are paying this year to get what we have paid as dividend.
Yeah, that is exactly what we mean. And that is why, if, for example, in this question, there was no proposed dividend, then the figure could have been how much for dividend paid? 5,000? 5,000.
5 million, yeah.
Yeah. If we did not have these proposed dividends, then we could have stopped there. Okay.
Okay, Mwalimu.
Perfect. Yes, Kevin.
I wanted to ask if there's a possibility of getting a question whereby you're given the actual cost on depreciation and also the percentage. If so, how will you treat that when you're calculating your net book value?
Come up again. It is possible.
If it's possible to get a question whereby you've been given a depreciating percentage, let's say on buildings or furniture, and also you're being given the constant depreciating value. So how do you deal with that when calculating your net book value?
Now, the only time you can be given, rates for depreciation is unless you're told that the depreciation for the year is based on the opening net book value, then you just take the percentage times the opening net book value or the cost, the same way we do when we are preparing financial statements. Remember when we are preparing financial statements and we are doing depreciation expense. You remember?
Yes.
Yes. Then at that moment, you can only adopt this approach. But rarely in a statement of cash flow question, will you be given again to calculate depreciation. It is usually either given or a missing figure where you balance the account. Okay?
Okay. Thank you. Yes.
Perfect. Now, we can see each other on Saturday. And today, at least, people to see my face.
Yep.
Those who have said they have never seen my face. Yeah?
Saturday at noon. Saturday is okay at noon.
Yes, at noon as usual.
After lunch.
Okay, so wish you well, guys. See you on Saturday.
Thank you, Mwalimu.
See you on Saturday. Thanks because I've seen you.
At least when we meet, when I will be an expert. An expert, how do you call them? The expert witness in a court of law. You can say hi.
When you meet me at Gachagwa's impeachment, then I ask you about the worth of the estate. Then you tell me you acquired.
We'll be asking about numbers. The 4% and the 35 points. They are things that do not have. You saw the impeachment of